All right, this is video 7 in the beginner's guide to properly structured whole life insurance. And this just dives into how loans work, how money flows, paying interest versus earning interest. And the one caveat I would make if I had to redo this video is talk a lot more about not just your money growing and compounding the rest of your life, but also all the other benefits that you get with life insurance and how they compound the rest of your life. And so later in this course, we're going to talk about things like retirement and future options. And that is one thing that, since making this course, I've been able to see people use their life insurance policies in multiple different ways. And the fact that it gives you the ability to control capital and use money while you get all those other benefits compounding is incredible. So I hope this video simplifies that and it just opens your eyes to the possibilities of saving $1 and also using $1 at the same time. All right, so we covered the importance of having our money grow and be able to use it at the same time, and that's the maximizer. And now I want to give you kind of the nuts and bolts on how you can apply this in your life using life insurance. Now this box right here represents your policy, and in your policy you pay in premiums or you have contributions, and that's the money that's going to grow the rest of your life. Now, we know that you have access to this money. You have something what's called cash value. This is money that you could take out, you could withdraw it, or you could borrow against it. And in every life insurance, in every whole life insurance, there's a contractually guaranteed option for you to have access to this money. Now, every company is a little bit different. We work with companies that it's very favorable to utilize your money in that way. But instead of using your money, you are using it as collateral to the insurance company. Now, when I first talk to people about this and they don't understand the importance of your money growing and they don't understand the maximizer, they're like, why in the world wouldn't you just use your own money? But we know that because we want our money to grow the rest of our life. And the cool thing about it is when set up with the right kind of company, when set up with a company, and I know I'm getting technical, that has non-direct recognition loans, which essentially means they don't directly recognize your loan and in fact give you the exact same interest and dividends, you essentially get to borrow against your money and your money is continuing to grow like it hasn't been touched, which is extremely powerful. And so I'm just gonna draw a little bit of rate of return out here, just letting you know that this money is not just getting rates of return, but it's growing for the rest of your life. Now, the insurance company is investing for the future because at the end of the day, they have to pay out a death claim. They have to think long term. So they're putting your money to work. But in the contract, they say if you want to have access to your money, they will loan to you before they put their money to work in other investments. Because again, you are a policy owner, you're an owner in this contract. And so I'm going to draw an asset, but at the end of the day, I'm also going to draw a question mark. Because as an owner, you can use your money with whatever you want. And now this is an advantage and a disadvantage. It's a disadvantage because it's not this magical like get rich quick thing. You can't just use your money on anything and just get wealthy. Life insurance in general is not a get rich quick scheme or investment. In fact, it's not even an investment. It's just a more efficient way to save and use your money at the same time. So regardless of what this is, it could be your business, it could be real estate, it could be hiring another employee, it could be marketing, it could be paying off debt, investing in school, or it could be going on vacation or buying that next house or buying your car. Regardless if it's an asset-based activity or a liability-based activity, this will totally work and you have complete ownership over it. So what actually happens is instead of taking your money, you're not taking your money, you're taking the insurance company's money, buying that asset, and then you have the total option to pay that back. And there's some interest associated with that. A lot of times, this interest rate is anywhere from 4.5 to 6%. And obviously we want to be careful and pay as little interest as possible, but that's what I call in my book the control cost. That's the cost of controlling someone else's capital. Remember back to the bank? Remember how banks pay 1% and earn 4%? They don't just make a spread of 3%, they make a 300% rate of return. What if you had a cost of capital at 5%? And you were going to invest in a real estate property and you were confident that you could earn 12%. Now, is there some risk that goes with that? Absolutely. And there's a lot of other questions that I could ask. But the rate of return is not the spread of 7%, but it's 140%. Because remember, your cost, your investment is $5 per 100, and you're earning 7. If you do the math, that's 140% rate on your money, all while your capital is growing at the same time. Now, one of the things that I also want to break down is the difference between earning interest versus paying interest. And now, if we get really technical, if we really look at the math and include opportunity cost, we have to understand that with opportunity cost, it's exactly equal. If you pay and earn 4%, you're exactly equal if you're including the opportunity cost in this equation. But we're just going to look at merely the money that you could earn in a compounding strategy versus the money that you would pay if you were going to pay back the insurance company or the bank during this time. Okay, so let's assume you have $100,000 in your account. Okay, if you have $100,000, and I'm going to make this green, this represents your money. And now we're going to look at over 10 years, assuming you could earn 4%. Okay, your interest that you would earn over 10 years would be over $148,000. Okay, this is, remember, your balance would be $148,000. The interest just by your money compounding at 4% over 10 years would be over $48,000. The question you have to ask is, by paying cash or by using your money, that would have cost you $48,000 over 10 years just by the activity. It doesn't matter what you're investing in, it's the activity. Over 20 years, your interest that you would have earned would be over $119,000. Over 30 years, the interest that you would earn would be $224,000. If you, by paying cash for whatever, over 30 years, that activity would actually cost you an additional $224,000, because that's what money you would have in an account if you're earning 4% on that. And now let's look at 60 years, and over 60 years, you would have an additional, in interest alone of earning, $900,000. Why is this so powerful? Because compound interest is not just earning on that principal, but it's earning on that principal and interest, and every single year it's an increasing amount. So I'm going to draw a little bit of like a increasing curve. Now what we're going to do in contrast is we're going to look at, what if you were paying interest? What if you were paying the insurance company? What if you were paying the bank? How much money would get transferred over to them during that time period? So now I'm going to write $100,000, and I'm putting it in orange to represent we're actually paying interest. Now, the difference between compounding is we're starting here, and every year the number gets smaller and smaller because your 4% is earning on a smaller dollar amount. Okay, so over 10 years, if you were to pay interest, the interest that you would transfer over to the insurance company or bank or whatever institution would be about $23,000. Okay, by just looking at the difference, why would you earn $48,000 and just pay $23,000? Why is that so dramatic? It's the difference between compounding and paying or amortized interest. Over 20 years, your interest that you would pay would be a little over $47,000. Again, that's really different than $119,000 that you would earn if your money was in an account. Over 30 years, your money would be, the interest that you would pay to the bank would be a little over $73,000. Again, that's a lot of money. If I just told you, if I gave you a loan and over 30 years you would pay me an additional $73,000, you'd be like, man, that's a lot of money. And you could be right, it's all relative until you look at what your money could have earned at that same interest rate. And over 60 years, and I know there's not really any loan ability to loan 60 years, although you potentially could do this in this scenario if you wanted. The interest that you would pay would be $165,000. And again, you have gurus on TV saying that's a lot of money, which they're right. If I just told you, here's what we're gonna do. I'm gonna loan you $100,000. Over the next 60 years, you're gonna pay me that $100,000. In addition, I'm gonna get $165,000. You'd be like, that's a good deal for you. Well, what if you did that and put that $100,000 to work, earning the same amount of interest? You have access to capital and your money grew over $900,000. So it's all relative. And the cool thing is, what we're teaching people to do is we're teaching people how to get this compounding the rest of their life and also give them access to capital. And it's not free, but you can see that this is the most efficient way to buy the things, to invest in the things throughout your life. Hey, it's Caleb Williams here. I want to thank you so much for taking time out of your busy day to watch our YouTube videos. We put a lot of time and energy into making them informational and helpful. I also want you to know that we do this for a living. So if you're an advisor, an agent, and want to learn more about the and asset and how to incorporate this into your life, check us out at theandasset.com. Also, if you're a consumer, if you're someone that wants to learn more about the and asset in your business or in your retirement plan or in your life, and asking questions like, would this be beneficial to me? We want to help you. You can check us out at andasset.com. We have links down in the description where you can get the book, you can watch different videos and learn more. We just appreciate you. We appreciate if you give this video a like, give us a comment, and share this with people that need to see this content.